Okay, good morning, everybody. This will be a recorded webinar for everybody who can't make it. The way these flow best for me typically is just asking questions as you go. So we promoted everybody here to panelists. So if you got a question, you can type it in, but you can also literally interrupt me and happy to answer questions as we go along. So, okay, we'll get started. So this presentation is how to offset active income without being a real estate professional. This comes from personal pain. Once upon a time when I was a dentist, I worked really hard building up my practice, made no money at all. Once I finally started making some money, I was writing very large checks to the federal government. They weren't there when I was starting my practice, but they were definitely there once I started making an income. And I spent a lot of time after that learning about the tax code and the IRS rule books full of stuff where it's like, hey, if you do this, we're going to reward you. These are the things we want you to do. And there's certain things like being a W-2 worker, being an owner, and not having a lot of depreciation that don't get rewarded. So I'm going to talk to you today about how to, um, mitigate the federal taxation doing what the federal government and the IRS wants you to do. So this is not a loophole. This is actually like literally following what they want you to do. So here we go. Okay, a little about me to start. So, used to be a dentist, used to run the largest, founded and ran the largest dental group in the Inland Northwest. But over time, you just learn more about yourself and what you're passionate about, and what you love. And what I love is creating cool buildings in my community. I love building stuff, and that's what I'm passionate about. So, my one company, it's a real estate development company, company that's a fund management company and one that is a construction company. And I like to stay vertically integrated so I can maximize control and maximize outcomes. What I learned when I was owning dental practices, if I wasn't there, the profitability, the culture, all those things just weren't at the level that I really wanted them to be. So it's important for me to be really involved in everything I put my hands on. For a real estate development company, we have about 400 million in development, mostly around the Spokane area. This is one of our upcoming projects, 12 townhomes and 42 apartments. I'm actually doing this one in partnership with the city and the state. They've put in about 3.5 million so far, so it'll be a fun community impact project to do together. Construction side, we have about 70 million in will be under construction this year, mostly apartments and townhomes. And then on the fund management side, like our real vision here is help people reduce their taxes and build wealth through tax strategy, curated investment opportunities, and personalized wealth blueprints. So this is like everything I've learned over the years, just helping people. Um, So when I'm serving somebody, my investors, I look at the top five investor problems. So these are the five that have popped up that I've seen. In general, people value um, active income tax reduction. We'll talk about that today. Capital gain tax reduction. Let's say you're selling stocks or selling your business. You can't 1031 out of a business like you can real estate. Cash flow, people got to eat. Cash flow is always nice. Yield greater than index funds. So historically, real estate, and I can show you this in another presentation, have historically higher yields than index funds. Returns and then diversification. If most people are dollar cost averaging into index funds, whether that's within their 401(k) or outside, diversifying is a great way to help build up a portfolio faster and get free faster. So I look at the best solutions I can find out there, and the best solutions I've found for yield, cash flow diversification, taxes is real estate. For capital gain tax, it's the opportunity zone funds are just fantastic. If you're not familiar with those, we do webinars. We'll do one in 2 months on that. And then today we're going to talk about equipment. And then on the fund management, just historical returns on our exits are 37% IRR, 49% ARR. And I think most of that's just due to being hands-on. Uh, so you can't do it without a team. So even though I don't have 160 employees like I did on the dental side, I try to keep it simpler. I have a great local team. This is probably about half of them. Just form strategic partnerships and really just do great things together. So if anybody has any questions, like I said, just interrupt me as we go. That always flows best. Okay, so we're going to talk about two things here. We're going to talk about kind of the model, and then we'll talk about the challenges with the model and solutions today. So in general, the issue is as we become more successful, either as a W-2 income earner or a business owner, we start paying a ton in taxes. Um, we have limited deductions. I mean, every time I go to an accountant or somebody, they tell me stuff like the Augusta rule or a 401k, take a home office deduction, take a mileage deduction, and the numbers that are significant to me, none of those are a drop in the bucket. So I spent a lot of time and energy like looking for like real deductions. And then we don't need another tactic. You need assets the tax code was designed to reward. So I don't want little loopholes that are going to get closed or like what I look for is like real stuff that the federal government is really supporting, and the code supports that as well. So yeah, so utilization of idle capital, and then addressing complexity and fear, always trying to simplify things. So I'm going from broad to more specific as we go through here. So the tax code rewards productive investment. If you're passive, you're not going to get a lot of benefits from the tax code. It rewards productive owners. So, having a business and making investments in your business. As a dentist, we get write-offs when we built out a new practice, bought a bunch of equipment, and then those write-offs would kind of disappear over time. Bonus depreciation. So in the big beautiful bill, we just bumped bonus depreciation back to 100%. And so this is a massive, massive benefit for manufacturing companies, equipment companies, anything that has hard assets, right? In dentistry, whenever you sell a dental practice, average when you sell, probably assets are mostly classified as goodwill. Let's say 80, 85% are goodwill, which doesn't benefit from this, right? So in dentistry, we didn't have a lot of great depreciation options. Leverage, like borrowing money, is rewarded by the federal government and the IRS. So the tax code favors like invest in your business. Um, let's go to the next slide here. So yeah, basically the IRS says, hey, we're okay with you not paying us today because we know if you're investing and growing your business or someone else's businesses, we're going to get more tax revenue in the future, right? They run the math, they know how that works, so they want to grow the economy. So basically, as an individual, you take your income, you buy assets, you bonus depreciate them, right? 100% in year one, and then there's that future growth that wins for everybody. I mean, you guys see folks that don't pay a lot of taxes. They're very tax efficient, where others aren't. They're writing large tax checks. So the ideal marriage is like keeping your cash cow income stream, job or business, but then having a heavy depreciation type model business, and then that marriage works well, right? Cash flow, income, and then heavy depreciation, right? So you want to have both businesses, but it's very hard to run two businesses and do them well. I've tried. I mean, I run at least three businesses now, but I've tried to even do the equipment one on my own, and it's very challenging. Um, so, finding the right equipment in the right for that market, obtaining the financing, acquiring the equipment, and then utilization, like finding people to rent the equipment, making sure that they're paying you, making sure that they're not destroying the equipment, storing the equipment when they're not using it, getting maintenance to it. watching out for theft risk, right? People love to suck the diesel out of your big, large vehicles overnight. Tracking the operations and then remarketing, selling them at the end. So it's just, I've tried to do this. It's just a lot of work and time, and um, it's just a whole nother business. So it's very challenging. So, so what we're really looking for is like productive assets, right? Like a real asset, like a real business, things that can be financed, rented, tracked, maintained, all the benefits, like the 100% depreciation year one, the leverage, cash flow, and an easy button. Thumbs does this make it easier for us. So a real operating system that makes ownership of equipment practical. Okay. So I did this on my own for a couple of years. And then when I found out about equipment share, I was like, dude, I wish I'd heard about this like 7 years earlier. Would have saved me a lot of taxes and a lot of energy and time. So we're going to cover this is the best solution I've seen. I'm going to walk you through it here. This is a great time over these slides to start asking questions. So okay, so Equipment Share headquartered in Columbia, Missouri. The vision here is reduce tax drag for us, own productive assets, and we keep upside. So Equipment Share is an operating solution for this part of the tax code. We buy the equipment, they rent it for us, and we benefit. A little about Equipment Share. So they were founded in 2015 by these brothers. They were contractors like myself. What's super annoying as a contractor when you go to rent your equipment that they said was going to be there and isn't there that day. You have a very tight schedule where, the electricians are here this day, then the plumbers are here the next day, and then the framers, blah, blah, blah. And if somebody like fails your schedule, right, it hurts everybody, right? Because all those electricians, plumbers, all those tradesmen have other jobs they've got to be on too, right? So it really costs a lot of money, time, goodwill when the equipment isn't ready and functional. And so the other thing is sometimes you get the equipment, it's been there for an hour and then it breaks on you, right? So these guys went through those pain points. Usually any good business idea is the impetus, the motivation, the muse is pain. And so these guys were super annoyed by that. And so they decided to start an equipment rental business. And one of the unique things they did is they went to Peter Thiel's Y Combinator down in Silicon Valley. And so a lot of what they did and a lot of what made them successful was the integrated technology right away. And so that's really differentiated them from the other rental companies. If you think about like Sun Rentals, United Rentals, and Herc, those are the three biggest. But these guys went from zero revenue in 2015 to 4 billion in revenue um, last year. So these guys have a great business model, and they actually just went public this year. So a couple months ago they went public. So they're doing fantastic. Um, so yeah, about 4 billion in revenue last year, fourth largest rental company, just growing. 373 locations, so all across the US. I mean, if you go on Google Maps and type equipment share, you probably have one near you, over 7,000 employees. So whenever I do something, I always look for a strong strategic partner, right? And so having a company, a publicly traded company, right? So they're audited up the wazoo, and they've got a great track record and a great growth. This is the kind of company that I want to associate myself with. So
Hey, Josh, what was the symbol for their public trading?
I don't remember. Brian, do you know off the top of your head?
It's EQPT.
Thank you.
So Brian, I'll get into Brian a little bit more here, but Brian works with me on this and he's on the, the presentation today. So, yeah, so equipment share, what do they rent out? A lot of aerials, like scissor lifts, telescoping booms, like these guys in the background, are very popular. Forklifts, telehandlers, like material handling type stuff, and then earth moving, which is I do, like excavators, loaders, dozers. We have a ton of, we own, I don't know, 4 or 5 pieces of equipment. But, if we don't use something a lot, like if we're not keeping it busy as a contractor, right? We have to keep that. If we're going to buy equipment, we got to keep it busy, right? We got to be using it because it's expensive stuff. And so anything that we're not using all the time, all day, we're renting. And so is everyone else in the industry. So, excavators, loaders, dozers, all sorts of dirt moving stuff. Great brands, great reputation as a company. So, okay, let's talk a little about the program. So, this is where most of the questions are going to come. So, who's it for? High income earners and family offices. Uh, you are an owner of the equipment, and the minimum purchase this year is 500,000. And as Brian can tell you, a lot of family offices buy 20, 40, 50 million high net worth individuals of equipment each year. The term on the equipment ownership is 6 years. After 6 years, Equipment Share buys it back. The average leverage I see on these is, you would put in, or I put in 13%, and then the debt is about 87%. And Brian's company, Brian used to work at Equipment Share, and so they have a debt brokerage that Brian's a part of called Bevel. And Bevel finds the best debt, leverages Equipment Share's 4 billion in size to find the best debt for you. The cash flow on average that I saw that I see is about 6 to 8% right now. That's really based on interest rates. And so if you can get debt on your own at a higher interest rate, maybe borrowing off your securities portfolio, right? If you had a couple million in index funds, and you get a better rate, then your cash flow might be double that. Just really depends on the interest rate. Tax timing. So the great thing here is the depreciation is concentrated in year one. So most people write off all the equipment in year one. Um, so the management is handled by another third party that Brian's affiliated with called Armada. So they make things simple for us. They handle like the management pieces, the insurance, repairs, all that kind of stuff. So they're kind of the bridge between Equipment Share and us as owners. So when you run the math, when you're looking for tax efficiency, oil and gas is kind of like the first thing people's mind goes to because they have their own like piece in the tax code. But if you run the math here on like for every dollar you put in, how much do you save in taxes? This is 8 times more efficient than oil and gas. So that's what attracted me to this. And that's when I heard about it the first time. I was like, dude, a friend of mine who's a developer, he was doing this, and he told me about and I was like, oh my gosh, this is fantastic. And so I've been doing equipment about the last 4 years. So um, the program within Equipment Share itself was founded in 2018. So they've been doing it about 7, 8 years now. Over $3.5 billion worth of equipment has been purchased through this program. Like I said, if I'm bringing in my investors, my friends into things, it needs to be like lowest risk. So, and then another thing is like the way I understand, like back in 2018, it's like, okay, somebody buys like $1 million, $2 million worth of equipment, whatnot. Well, if one of those pieces of equipment like has a random accident or there's a car accident or something, right, that can affect people's revenue. So, Brian can speak more to this, but typically I see a Marmada pool about 25 to 50 million worth of equipment together just to kind of even out revenues for folks so you don't have any kind of little things affecting. So, okay, next slide here. Um, so, disclaimer, right? This is for educational use, illustrative economics only. Tax and legal decisions should be made with your own advisors, right? I'm not an accountant and attorney, but this is how I see things. These are just my personal opinions. So I use $1 million of equipment. minimum is 500K purchase, but I use 1 million just because it's the easiest to do the math. Okay. So on a $1 million purchase, you or I as the participant would put in $130 and 130,000 in cash. Bevel Financial and Brian would help us find the other 870 through debt. Depending on your tax situation, that savings could be about 350,000. Okay, so you were going to write the IRS a check for 350,000. Now you're keeping that 350,000. The cash flow at 6 to 8% on this size is about, eight to $10,000 a year. And then in year six, when the equipment is bought back by equipment share. And at that point, they usually buy back the equipment at about 55% of the original price. You pay off your remaining loan with that money and get your initial equity back. And then that is taxed at ordinary income rate tax. So that is a taxable event at that time. And I'll kind of walk through what that taxes look like on the right. Um, um, or what I do each year is I just use the Beck's tax strategies as the year. So in year six, 6 years from now, I'll probably use maybe some real estate depreciation. I buy more equipment or whatever the best tax solution is that year to mitigate those taxes. Okay. Um, I'm going to kind of walk through this piece here, but any questions about this before I kind of walk through the flow of funds?
Hey, Josh, so I'm assuming if you purchased like excess because you overplanned, that you could then roll over that into the next year. Is that correct?
Yeah, yep. So not a tax
Yeah.
professional, but yes, typically
Yes. Yeah.
anything you buy that you don't use that year in depreciation, it's like a piggy bank. It's a net operating losses. You just carry those forward to future years. Yep.
Yeah. All
So
right. Thank you.
great question. And so, kind of with that point here is what I typically recommend is what I do now. So, what I used to do was wait till like Q3 to figure out my taxes for the year and then try to figure out a solution like into Q3 and Q4. But I'd always be like buying a building like over Christmas, trying to get a hold of banks, attorneys, not enjoying my Christmas time with my family. So, what I do now is kind of addressing like the strategy to Darren's comment is I typically try to figure out what my estimated income and my estimated taxes are in Q1 of each year. And then in Q2, I try to implement like my plan, right? So let's say I have like X amount of income for the year, and I'll say, well, I have a bunch of depreciation from real estate. So this is the income that's not protected. Okay, I'll buy that much equipment, right? And I usually do that so like Q2 would be the time to do that. Brian is getting allocated through Amada about 100 to 200 million of equipment for equipment share in June, right? So I'll try to be part of that piece there so I can um, enjoy my Q3 and Q4 and not have like a tax monkey on my back during those months. So okay, let's talk about cash flow. So let's say buying a million in equipment has saved you 350K in taxes that this year. Then you put 130 of that into purchasing equipment. So you got about another 220 capital free to invest in real estate or whatever you like to invest in. You saw my historical return. So for me, turning that 220 and doubling it over 6 years is not historically a problem. So I just used simple math and doubled it. And then when you sell the equipment back, you get your original equity minus like fees, etc. So about 540 in gross value before recapture. Um, if you're selling at 55%, I could add this in here, at a 35% tax rate, your taxes would be 195,000 that year. And you take 540,000 and you minus the 195 in taxes, means your net like cash is 345K plus the 6 to 8% annual returns. So you've literally taking $0, right? You were going to hand this $350,000 check to the IRS and have zero to show for it, and you've turned that into 345,000. So this is kind of the model about how I think about it and why I do this, and have been doing this the last few years. This is a great place to ask questions. What other questions do you guys have? Anybody?
Josh, do you want to speak about the specificality of the assets and how you're able to achieve active hours?
Yep, that is in two slides. Let's go to the spreadsheet slide. So everything I just had on the previous page, kind of broken up into areas, is here in a pro forma. So typically, Brian, once you get the debt terms from the lender, right, and you have the equipment incoming from equipment share, is this the kind of spreadsheet that you're going to share with potential participants so they can make a decision if they want to make a purchase?
Absolutely. So there's no cash outlay or commitment fee for you. What we're really looking to do is get allocation for you. So we don't allocate out any equipment until you're pre-approved from like a lending standpoint. If you want to come in and make a full cash purchase yourself, or you bring in your own leverage from a local lender that you have a good relationship with, you're more than welcome to. We just do not allocate out any equipment unless we know we can get paid for it, and that's just due to the amount of demand that we have for these assets. A good thought is the last 2 years in Q4, we've had over $400 million worth of demand that we just didn't have equipment for to allocate out to. So that's why Josh is really pushing towards trying to get activity in Q1, Q2, and really try to get this thing sewed up before the end of Q3.
It's not fun to tell people we can't. There's no equipment left in Q4. It's not a fun thing to tell my friends and investors and colleagues. So yeah, trying to get the word out that way. People always have the opportunity to do this early on. Let's talk about the tax fees. Actually, that'll be the next slide. So yeah, the simple process, like if you got questions or whatnot, just set up, we can just do a discovery call. Andrea put that link to set up a call in the chat, or you can just text me or we can set up a call. And then after you kind of make sure you feel good about things, understand it, fits your situation, then there's a lending application on Bevel Financial, and you put all your info in there, your tax returns from previous years, etc. And then Brian will take that to his curated lending pool, find the best terms for you, and get you one of those spreadsheets so you really know what your situation would look like. So it's good to just get that there. That way, as you're doing your due diligence, you're talking to your accountant, all of that. Like Brian is in the background working on the lending for you. So yeah, you can both do due diligence um, while Brian's doing this for you, and that seems to work out well. And then if you accept, there's a fleet allocation from Brian and the purchase, and then operations and monthly reporting. I mean, this usually starts a month or two later. It's pretty quick, and then the 6-year payoff. So okay,
So Josh, can you explain? I'm missing the lending component part. The why are we going through a lender? So I mean, if we're
yeah,
purchasing equipment shares, where does the lending part
yes.
come?
Let me kind of handle this all together in this next slide. I think I can make that more clear. So we talked about earlier about pairing your high income business or your high income wages with a heavily equipment or manufacturing based company that has heavy depreciation. So pairing those two, it's hard to do both, run two companies on your own. So like, what does equipment share do? So the model and the system is, you set up an LLC. I'm not a tax professional, but I usually say, hey, just I'd recommend I mean, talk to your accountant about it, but just maybe set up a new LLC so it's clean. And then that LLC buys the equipment. Okay. And then Armada does the management piece, and Equipment Share is renting out the equipment for you. So your equipment could be in Maine, could be in Texas, it'll probably be a few different places. And you have an app on your phone, so you can always see your equipment, all the serial numbers, where it's at, how long since the last maintenance and the next maintenance. There's so much information in there. So you have that. So you're technically an owner. And to be able to write off the depreciation actively, my understanding of the tax code is you have to be at risk, which means you have to own the equipment, you have to be the owner of the loan on the equipment. That is that is on you. This is like to get the tax benefits, you have to have a business. And this is the simplest way, the lowest risk way I've found to do that. Material participation on this, I have a sheet I can send you, but it's 100 hours, is my understanding, is what I do. So how do I get those 100 hours? Well, checking my app, that's like an hour a week. So over the whole year, that's 50 hours right there, 52 hours. So now I'm down to about 48 hours left. I can visit some local equipment share locations, emails, correspondence. There's 10, 20 hours. I like to go visit headquarters every year. Columbia, Missouri is a college town. As you can see, here's Brian and I visiting one of the sites and eating at one of the famous hamburger places next to campus. So I enjoy going there and just reconnecting. So I do that. We have a couple events coming up, a couple tour dates that I'll share at the end. For your 100 hours, logging that stuff is always helpful in case there was ever an audit. I mean, the IRS isn't really overstaffed. Audits don't happen very often, but I always say, hey, follow the rules and protect yourself. And if you ever get audited, you can discuss it with the IRS. You can pay the 6% penalties. You can take them to court if you really don't agree with them. I mean, it's just kind of how it works in our system. But you should definitely coordinate with your CPA, tax counsel, legal advisor here. Um, Brian, did I cover kind of the main things on this? And then Darren, did I answer kind of your question?
Yeah, I was going to jump in here really quick. So, something to think about, Darren, to your question is equipment share is the rental house. They're going to coordinate the rents for the individuals. Armada Fleet Management, we possess a master revenue share, remarketing agreement, and limited loss agreements with that of equipment share. And so when we buy our tranches of assets, anywhere from 20 million to $100 million at a time, we're able to then turn around and sell off specific tranches of assets to individuals like yourself, and we're able to reassign those rights. So, frankly, like we're a fleet aggregator in that sense. A lot of individuals think that they can go directly to equipment share and buy assets. Equipment share has no interest in working directly with individual purchasers of assets. They want to work with a fleet aggregator like ourselves, and so we have a unique position, just being at the forefront of this whole program.
And so, but more that still doesn't answer, I guess, my loan question. And then also, I guess another question: is there a percentage that you guys get paid? I'm sure, right? Is a part of the other piece to the puzzle.
Yeah, so the loan aspect of it, a lot of times individuals are wanting to use leverage to maximize their tax return or their tax benefits. More than welcome to come in and buy a full fleet of assets without leverage, but I would say 99% of the time, individuals are wanting to utilize leverage to maximize those returns. And so, if we walk through this waterfall here that Josh has presented, typically what we're going to see is 10% of your equity injection goes to the down payment of the note. 3% is actually the fee to Armada. So that fleet aggregation fee there is important. Armada is not charging any reoccurring management fees. They charge one fee up front. And then what we're passing through to you is fixed maintenance and repairs, insurance, and technology expenses. There's a loan origination fee of 1.25%, and that goes to Bevel Financial. And we do not make that a cash outlay. We actually bake that into the principal of the note. And so when you look down at the bottom there, what we're really trying to achieve and by design, service the note and service all the maintenance, repairs, insurance, T3 expenses to make this a turnkey solution for you. But again, you don't have to utilize leverage. It's just most people elect to utilize leverage.
So can you just run a number scenario? Let's say I owed $500,000 in taxes, like, and I'm trying to you know uh, utilize this as not paying and et cetera. What can you just run like a number scenario into if I bought it outright or took a loan or et cetera, interest rate stuff like that.
Yeah. So if you're looking at this here in this scenario, right? So if we're buying $1 million worth of assets, and let's just keep layman's terms here, 37%, taxable rate, you're going to be able to offset, $1 million worth of income typically and save roughly $370,000 worth of taxable income. With that, or I shouldn't say taxable income, taxes. So if your number is 500,000, you're just going to back into that number based on your rate. So it may be closer to a $2 million purchase.
Um, and maybe I can answer another way. Darren, you were mentioning, so was it 500,000 in taxes or 500,000 in income that you were trying to mitigate?
Just say and again, you could use the million number. Just say I'm going to pay a million in taxes, right? This is the money I'm trying to reduce in taxable income, or 500,000. I'm trying to follow. I mean, I'm usually pretty good at numbers. I'm just having a little
Yep.
difficulty following exactly what my outlay is. Who am I? Where am I borrowing money? How much money am I
Yep.
borrowing? What interest rate I'm paying? I guess to run through a couple scenarios is if I
All
just to kind of run the numbers through I guess a scenario.
and I will do that. And I just want to clarify, is it let's say use a million, is it a million in income that I'm trying to mitigate the taxes from, or is it a million in taxes I'm trying to
Well,
mitigate?
I guess either one. Either. I mean, I can do the other math just to have a straight. I mean, if you already have a slide set up, just make it clear that that's in income or that's in taxes, and I can do the 37% or whatever in my head. I mean, that's fine.
Okay.
But I'm just trying to run through a scenario, just like, hey, if this was me and this was the money, what scenario am I doing?
This
Yes,
this slide is made for that.
yeah,
So
perfect, yeah.
I have $1 million in income coming in this year that I have no tax solution for. Okay, maybe my income's 3 million. I have other solutions for 2 million, but I have a million left of like active income tax, right? 35, 37% that I don't have any solutions for. What I'll do is I'll apply for $1 million worth of equipment because when I buy that $1 million worth of equipment due to bonus depreciation, I get a write off all million of that equipment this year. So my income would go from a million to zero. Okay. And there are some nuances you have to look into on that. One is called EBL. Um, but in general, let's keep it simple for now. So I have $1 million in income that I don't have a tax solution for. I buy a million worth of equipment. Whether I use leverage or not really comes down to how much cash do I want to put in to reduce my income from a million to zero this year. The most common leverage I see is me or another participant will put in 130,000 in cash, buy $1 million of equipment with 870 in debt, which allows me to put in 130 in cash, take a million off my income this year, save 350,000 in taxes.
I'm with you.
Okay. Um, so really, yeah, the debt piece is really how much do people want to put in versus um, versus that tax savings. So
So you're financing the other nine or 870, and that's through a company, and that's charged at a certain interest, but you're getting money back um, on the money you put in, right?
you would have like this happens on your own side, not within Bevel or Mod or anybody. This happens on your own side, right? Like I know I'm going to have to write the IRS a check for 350,000, right? I have 350,000 sitting in cash in my bank. And I can say to myself, okay, well, instead of giving this 350,000 to the IRS, what I'm going to do is I'm going to use 130,000 of this 350 and I'm going to use it to buy equipment, $1 million worth of equipment. And now I do that with the debt, and now I don't owe the IRS 350,000, right? I have all that depreciation now.
Yeah, got it.
Got it. And Darren's super sharp, guys, so I appreciate him asking these questions. Like I've done this for 4 years, so for me, it's just like it's like a habit. So I really appreciate Darren slowing us down and
Slowing us down,
asking the key.
asking the key.
And Josh, this is Ina. I don't know if you can hear me. I'd like to ask a follow-up question to Darren's.
Yes.
Yes.
Yeah, perfect. So I understand that basically the math here and the tax savings, they all kind of hinge on being able to kind of deduct that 1 million right off the bat to offset your income. And so I understand that based on your other slide kind of also hinges on that active participation and being able to track your hours. I guess like I'm not a CPA and I know you're not either, but I kind of just want to get an understanding of this. So like based on what I've read, not only do you have to put in 100 hours, but you also have to put in more than like anyone else. So
Yeah.
I guess if equipment share is taking care of like, all the day-to-day execution and the planning, which is what we want, right? How do both of those kind of coexist? How do I show that I'm putting in more effort than anyone else, but at the same time, I'm not really doing all the work? Does that make sense?
That's a great question.
That's a great question. Um,
Brian, do you want to handle that one?
Here. Yeah. So a very astute question there, and this is what's really key here. So as Armada buys these pools of equipment, and when we sell, say, $1 million, it's not going to be exactly $1 million. It's going to be maybe 1,005,000 or $99,000 or $999,000. We're going to get close to a million, as close as possible. All that to be said, it's a specific asset. You're getting a serial number asset. You're getting full ownership of said asset. You're just enrolling into Armada Fleet Management's pool, their fleet aggregation. With that, you're getting access to T3 operating system, which is the proprietary system that Equipment Share utilizes and is built. And what that really illustrates is your ability to jump in and manage your fleet. And so what we're seeing typically is individuals standing up single member LLCs. And from there, their time associated with their specific fleet will be greater than, say, my time against thousands of assets that I'm looking at. So if it's ever contested, my time on your fleet will be very fractional because it'll take my time divided by all the assets inside the pool versus your time divided by maybe 10.
Got it. That's really helpful. So it sounds like forming that LLC is kind of the key to all this.
We
Yeah.
will not
Okay.
sell, we will not sell to individuals.
Got it. And then do you guys in your team also have like, I guess, CPAs that are maybe kind of close to this that could also help out? Like, for instance, I know my CPA would know nothing about this.
Yeah, that's part of what
Yeah,
I
that's
do.
part of what I do.
As I jump on with
As I
calls,
jump on calls,
we may have.
we may have.
Additionally,
Great.
that we can point you in if you want to bounce ideas off of them or look to work with.
That's super helpful. Thank you.
I know I have my personal accountant too is very familiar, so he's happy to help as well. So, and that was a key question. I mean, that's one of our main FAQs. So, great job answering it, Brian, and good question. I know. Um, any other questions? These are the key pieces here. Okay, so who is this for, and why now? This is for high income taxpayers looking for real asset exposure and potential tax planning benefits. Participants comfortable owning equipment through their own entity, and participants who value outsourced management and transparent reporting. It's very hard to buy a bunch of massage chairs and or tanning tanning beds, set them up at the mall, and have $1 million, $2 million, $3 million worth of depreciation and run a business. So this is a nice alternative to doing your own equipment business. Um, the tax pain is current. The tax pain is current, not theoretical. I mean, yeah, I think these are kind of the summary points. So. Yeah. So if you guys have questions, there's the link in the chat to set up a call with me, or you got my number, my cell phone number, or you can email info@Cochran Cap. So subject equipment, and my assistant Andrea will send you about 8 documents, a lot of the background stuff, legal, accounting, those types of things that you can read through, throw into Chat GPT or something, and it's there for you. And then review with your CPA. I mean, as I mentioned, like say about 5% of CPAs are super proactive on this kind of stuff, and any kind of real estate alternative investing, they're always interested. And those are usually the guys that have larger clients, right? 50 million, 100 million plus net worth clients. Those guys are usually pretty savvy. The dentists I mean, the accountants who focus on serving dentists, those kinds of things, those guys don't typically, they're not aware of this stuff. It can be overwhelming for them. Yeah, Brian and I are both happy to refer to CPAs who work in these spaces. So, all right, less than an hour, so that's a win on the presentation. Those were great questions today, Darren. I appreciate you guys asking. Any other questions that you guys have?